Back in 2006 and 2008, I bought two almost identical multifamily properties, but one completely outperformed the other. Why? Stick around, because what I learned might surprise you. I spent nearly 2 decades buying, managing, and refining my multifamily real estate investment strategy. After owning and investing in thousands of units, speaking with countless investors, I've developed a blueprint that works, and I'm sharing it with you today. Welcome to Strategy Saturday. I'm Charles Carillo, and today we're discussing how I adjusted my multifamily investment criteria over the years to improve tenant retention, reduce headaches, and increase returns. If you're a real estate investor or thinking about becoming one, you're in the right place. I began investing in multifamily real estate in 2006 with a 3-family house where I lived on one floor and rented out the other 2. 2 years later, I purchased another 3-family house literally a few hundred yards away from the first, and it always performed better than the first. And I remember speaking to my father about the dramatic difference in time I spent on one property versus the other property, and how the second one always kept better tenants for longer, which is the key to success in multifamily investing. And he suggested that maybe I should replicate what I did with the second property for future investments. So the main differences between these properties was that the second property was in better condition, had better parking, and bigger units. It was an overall better property, and this attracted better tenants who lived there longer. Now, over the years, as I have been involved in more real estate deals and spoken to more investors, the overall theme of my investment criteria has been to invest in better properties in better areas. In 2020, we purchased our last C-Class property. It was in a syndication, which was sold in 2023, and now my holdings are exclusively B-Class properties. I'm not opposed to C-Class deals if I buy them myself. However, we do not purchase them with passive investors. So I have 2 multifamily investment criteria. One for syndication deals, so that's deals that we're doing with passive investors, and one is a joint venture one, which is what I do with maybe 1 or 2 other active investors that we work with. We buy properties, and I'll not go into how we pick markets in this episode, but you can check out episodes SS1 and SS2 to learn more about choosing markets. But the main difference between the 2 different criteria is the minimum units. For syndications, they need to be 80 plus units, preferably 100 or more. And the reason is that it allows us to have a full team of people on site. This makes management much easier while also making it less expensive on a per door basis. Also, if you're raising money for syndication with all the legal fees that go with it and all the hassle that goes with it, you want to make sure it's actually worth it. You don't want to do just a small syndication deal. For joint venture deals, I'm preferring 15 to 30 units. I might go down to 12 units if one of my partners has another deal in the area with a good management company, but that 15 to 18 to 30 unit kind of range there, you speak directly to the owners, and most of them are mom and pop investors, so you are also not dealing with syndication firms bidding alongside you. And that is a huge benefit, being able to speak directly to the owners and see exactly what they're trying to accomplish. You can assist them with that while also buying the property yourself, making it a win-win. So breaking down the acquisition criteria, we'll see B-Class properties for syndications, B-Class areas, and possibly C-plus properties for joint ventures. So I'll go down a little bit with that. And the reason really with C-Class properties is that, first of all, they're older, so sometimes they're a little bit more management intensive, and that could be on repairs like on the bones of the property. It can be with the tenant base. They can be a little bit more volatile with how the rents come in. They might not be consistently even every month, whereas when you get into better properties, the cash flows are much stronger. The other thing, too, with C-Class properties that you'll get is that it's going to be a little bit more time sensitive and time urgent, certain things. So that's something that you have to have the right team that you're working with, the right property manager, and that's with anything, but C-Class properties are a little bit more time intensive. 1985 vintage properties are the oldest, preferably 1990s or newer. If it is a longer term hold, I might be looking for a 1995 or 2000 or newer property. And when we're getting down to kind of the mix of units, it's 2-bedroom units. Like to see 50% or more of the units are always preferred to be 2 bedrooms. And for 1-bedroom units, I want to see a minimum of 600 square feet. And for 2-bedroom units, a minimum of 800 square feet. For construction, it's block and brick construction with pitch roofs are always preferred. Now, our acquisition criteria worksheets always have a deal killer section, and some of the deal killers are high crime areas. Obviously, people don't want to live there, or they don't want to live there for long periods of time. You can't fix it, and your property is always going to be stuck at one level. If you're buying in better areas, it allows you more flexibility with growing the property, doing work to the property, and actually achieving higher rents and a higher net operating income. Now, areas where the median household income is less than 3x what we project as our target rents in our underwriting, because if where we're looking at doing work to a property and doing renovations, if the median household income in that area isn't 3 times that what we're going to be renting them for, that means people living in the area can't afford to live there, which really kills the whole idea of renting the property. Now, areas with declining population, we always avoid. Anything with polybutane piping, which was a piping that was used like in the 80s and 90s, which, it explodes, it's not safe, you can't get insurance for it. Aluminum wiring has a mess of different issues, galvanized and cast iron supply lines. These are a lot of like the bones of the property that we don't really want to deal with. Unless, obviously, there's always a way, that you would get involved with this if you got a really good deal. But the thing with these renovations is that they're not going to add rent. They're not going to add net operating income to the bottom line. People aren't going to pay more because their pipes aren't bursting or leaking, or that they are able to use the electrical in their apartment, right? So these are things that really need to be done, and you need to buy these properties at quite a discount if you're going to be doing these renovations. The next thing is ceilings under 8 feet. This is not something that you're going to find being able to push rents really with this type of property. It's the same thing if you're buying properties, older properties, let's say, or any type of properties that don't have, especially in like the South, HVAC, like central air systems, window units, stuff like this, or wall units. This starts to limit the amount of money in rent that you can charge. So it's important that you know about this functional obsolescence and knowing that if you have it or if you don't, and make sure when you're doing out your rent comps that you actually know what you're buying. So if you're, doing your rent comps with something that, a property with higher ceilings or with bigger units or with central air versus the property you're buying has window units or has, smaller units in general, these are all important things that you have to work out and check when you're doing comparables. The last thing really is no in-unit laundry or the ability to add connections. So those are really important. If we're doing a syndication, there has to be a way on the ability to add connections and laundry inside the unit. This is one of the easiest ways of adding of doing renovations and making money. Literally in up, down, sideways markets, you can add laundry into a unit. You can get your money back literally in probably 1 year to a year and a half, the return of what you spend for doing that. So it's a great investment. On-site laundry facilities are okay for JV deals. So if you have an older property, maybe there's a storage shed out back or a storage unit, or if you're up north, you have a basement with laundry. We used to do that as well. Have the connections in there or have coin-operated laundry. But it has to be an ability of having it on site either way. But when you're doing syndications, we're doing better properties in that area that are going to have higher rent increases. You want to have that stuff in the units, and you want to make sure the units are what the market has for that size units and what they're selling for, or larger, which is even better. And these little things might not sound big because people rarely put in their Zillow listing the height of the ceilings. However, this is what makes the units rent fast and keeps the tenants in there. When they're in these better units, they go, maybe they're checking around their renewal and they see, oh, wow, this is much more expensive. It's not as nice. And they're going to stay put with what you are. And that's how you do it. The key is buying good properties, keeping good tenants in there. And I highly suggest for all real estate investors to create one-page acquisition criteria for the properties they want to purchase. And this doesn't have to be intense, doesn't have to be very detailed. It just can be quick bullet points like I just went over with you today. And showing this to a potential investor or a broker goes a long way toward building your credibility, since most tire kickers out there will have very general acquisition criteria saying, I want to buy properties with, this cap rate in this town, compared to someone that says, I want to buy properties that are 18 to 30 units built between these years with this type of construction. And I've left out the markets you want to invest in. That's obviously something that you want to make sure that you list these. And for syndications, you can have a larger area since properties will have on-site management. But if you're building a portfolio of smaller properties in one area of a city, clearly note that, because once a broker has a deal in or near that area, they're going to reach out to you because they know this is your specialty and that's who they want to be selling to. And it's much easier for them to sell to the seller as well. So I hope you enjoyed. Please remember, rate, review, subscribe. Submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then.
Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals?
couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.